All right, so our next panel is called Minding Your K's and Q's, the latest issues and developments in financial reporting fraud. This is a great panel. We have a terrific moderator, Stephanie Avakian, who's a partner at WilmerHale. She's based in DC and leads the firm's Securities and Financial Services Department. Stephanie, of course, is a former director of the SEC's Division of Enforcement. Thanks for joining us, Stephanie. Appreciate it. Trevor Donelan, partner and managing director at AlixPartners in the Investigations, Compliance, and Privacy Practice, and he's based in Boston. Trevor has over 20 years of forensic accounting experience and previously served for 8 years as a senior enforcement accountant in the SEC's Division of Enforcement. Welcome, Trevor.
Thank you.
Next down the line is Jimmy Fokas, a partner at BakerHostetler based in New York. He's an experienced white-collar and enforcement defense attorney. He previously served as senior counsel in the Division of Enforcement in the New York Regional Office of the SEC. Our representative from the SEC on this panel is Tom Smith. He is an associate regional director in the SEC's Enforcement Division, where he oversees the enforcement program in New York. And Tom previously served for 8 years as an assistant regional director in the Enforcement Division. Thank you so much for joining us, Tom. Finally, Carolyn Welshhans is a partner at Morgan Lewis in the Washington, D.C. office. Previously and recently, Carolyn held a number of senior leadership roles at the SEC, including associate director of the Enforcement Division and acting chief of the division's crypto assets and cyber unit. Welcome, Carolyn. Stephanie, I'll turn it over to you.
All right, thanks, Bruce, and congratulations, Bruce, on a very successful foray into New York City. So let's get started. Why don't we start with Tom?
Excellent.
Nothing's really going on. Nothing's changing. Nothing's going on, right?
I'm surprised we're starting with me.
Really? Why don't you talk to us about some of the more recent developments in the accounting and financial fraud space?
Sure. Thank you. Good morning, everyone. Thank you for having me here today. And I will begin. I'm sure you've heard it at least once already with the disclaimer I have to give. What I'm about to tell you are my own views. They do not reflect the views of the commission, the individual commissioners, or the staff at the SEC. So as Stephanie teed up, given the title of the panel, Minding Our K's and Q's, I thought I'd mention 3 accounting fraud disclosure related cases that the commission instituted at the end of 2024. All 3 were settled matters. All 3 involved charges and violations of Section 1782 and 1783 of the Securities Act. And also, they weren't all exactly the same, but various books and records, reporting, and internal controls charges under Section 13 of the Exchange Act. And also, what I would consider fairly sizable penalties for publicly traded companies. The first one is the Becton Dickinson matter. Becton Dickinson was a New Jersey medical device manufacturer, and basically the case there alleged that, or found that Becton Dickinson had materially misled investors about the risks associated with the continued sale of a medical device that it manufactured. The order gets into a whole lot of detail about what happened at the company between 2016 and 2020. The early part of the period, the company came to learn that the medical device, it was something called an infusion pump. The device had some software flaws, some software upgrades were required, and I think the company, again, dealt over the next few years with how to make those upgrades, how much those upgrades would cost, whether those upgrades would require regulatory involvement of the Food and Drug Administration, since this was a medical device, how much that would cost, and how long getting those medical upgrades, I guess, signed off by the FDA, how long that would take. The record in the commission order shows that the company, I think, struggled with its disclosures and what to say, and also what to say to its investors and things like earnings calls. Ultimately, in early 2020, the FDA, I think, based on conversations with the FDA, the company stopped sales of the pump, disclosed that it would have to do numerous upgrades to the software related to the pump, would have to go through a regulatory process to get sales of the pump approved going forward. The pump itself, sales of the pump, we alleged in our order accounted for something like 10% of the company's profits. Upon announcement, the company's stock price fell 12%. And then the company has, I guess, embarked on the path to fix the pump, get the pump upgraded, get the approvals it needed. The company settled the case with us, again, regarding misleading disclosures about the risks. It did not disclose over the period of 2016 to 2020 the risks that the FDA would step in, that more upgrade work would be required, that it might take some time, that it might not get approved. None of those risks were disclosed. Ultimately, the company agreed to pay a $175 million penalty, and also to engage an internal compliance consultant to look at the company's disclosures, disclosure controls, internal accounting controls, et cetera. The second case I'd like to highlight involves UPS, the parcel service. UPS had a business, a portion of its business called UPS Freight. UPS, through a variety of internal work, I think it was in the market, thinking about trying to sell UPS Freight, and it had valued UPS Freight at about $650 million. At that value, the goodwill that the company carried on its books for that part of the business would have had to be written down, and I'm going to apologize. We're going to talk about this a little bit more in depth. Trevor's going to correct all the incorrect accounting words I use. But the company internally valued the business at about $650 million, but they also hired a consultant to value the business, and the consultant did some work and came back and said that the business was worth $2 billion. At the $2 billion figure, a write-down of goodwill associated with UPS Freight was not required. Over the course of the next couple of years, I think the company revisited this internal valuation. It stuck with the $650 million. The consultant stuck with the $2 billion figure. And then ultimately, the company agreed to sell the business for a number much closer to $650 million. And then it took a write-down of the goodwill. The case, again, the company agreed to settle the same charges, 1782, 1783, related to materially misleading financial statements, taking the write-down when they did, I believe in 2020, instead of in an earlier period, and then we argue the material effect this had on the company's balance sheet and earnings. The third case, UPS agreed to pay a $45 million penalty to settle that case. The third case I'll point out, also from the end of the year, involved Elanco Health Products. It's a company based in Indiana. It sold products to distributors. Distributors would then sell the product on to their final customers. Over the tail end of 2019, Elanco offered various discounts, reimbursements, and other incentives to sell product to its distributors. It had a very material effect on the amount of product that the company sold in 2019, helped the company make its 2019 earnings targets. Even while it was selling all this product, the company internally realized that selling all the product to the distributors, when they didn't have a real good sense that the distributors had a downstream need with their customers for all the product that Elanco was selling to distributors, that this might be a problem in the coming years. At the end of 2019, they decided not to do to continue the reimbursements and other sales incentives going forward into 2020. I guess somewhat unsurprisingly, earnings due to sales of the products were materially lower in 2020. When the company disclosed the lower earnings, the lower revenues, they talked about COVID and other effects of the pandemic without disclosing the fact that it had stopped the sales incentives and rebates and other things that had helped increase the sales at the end of 2019. We allege that was materially misleading disclosure by not coming and telling the investing public the true nature of the causes of the reduction in the revenues in 2019. So I think Elanco agreed to pay a $12 million penalty, if I have that right.
Yep, thanks, Tom. That was a good sense of some of the things that are more impactful in this space that we're talking about on this panel. Trevor, why don't you give us a little more, as Tom previewed, on UPS and goodwill accounting, and there are real issues of judgment around that, and so talk us through some of that.
Certainly can. Yeah, I mean, goodwill accounting is among the sexiest of the accounting topics. So thank you. As Tom touched on this, the UPS unit that was at issue here is UPS Freight. UPS was carrying it on its books at about $1.5 billion, which about a third of that was hung up in goodwill. As Tom mentioned, internal valuation analyses showed that price that would be paid by a third party to buy that entity would be substantially lower than that. Nevertheless, an external valuation firm came in and valued it at $2 billion, but the SEC orders is clear that management did not provide all relevant information to that consultant, including their internal analyses that might have affected the independent valuation. There were also certain flawed assumptions, as alleged by the SEC, in the valuation firm's analysis that again would have led to an overstatement of the fair value. There was also, in 2020, the company entered into a term sheet with a prospective buyer that sort of solidified that the sale was going to be substantially below the carrying value of the assets, and management did not share that information with the valuation firm. One thing that the order points out is the day after the UPS released its third quarter 10Q in 2020, the board authorized the company to move forward on that lower valuation sale. And so in addition to the GAAP error, which was not properly recording an impairment charge earlier, the SEC alleged that there were misleading disclosures around the company's accounting for goodwill. The company had reported that it was using its current and best estimates, and that there were no events or changes in circumstances that affected the carrying value of goodwill. There was a significant monetary penalty, $45 million, and additional undertakings, including the requirement to engage an independent compliance consultant to assess the policies and practices with respect to fair value estimates of goodwill. There was also sort of a bespoke undertaking that all CPAs employed by UPS involved in preparing financial statements for the firm had to go to remedial training in GAAP, technical training in impairments and fair value. Those are fairly rare in my experience, often with audit firms, but not with issuers. So in terms of takeaways from this, I think the SEC will continue to pursue these types of accounting and disclosure cases, even when the subject is as unsexy as goodwill or intangible assets, in certain situations, especially in a case like this when there's a subsequent confirming event that makes it clear and reveals that certain assets are undervalued or certain liabilities are understated. The roadmap for that from an enforcement perspective is fairly clear. Just roll it back a quarter and see what assumptions and estimates the company was relying on to not make those disclosures. In terms of remedies, the $45 million penalty does seem on the higher end, but it's not completely out of the realm of prior experience for non-scienter accounting and disclosure cases, even in the Trump 1 administration.
How about that Becton penalty?
Penalty's high. I would expect, again, on these high penalties, I would expect the enforcement staff to be put through the paces and put to the test on a go-forward basis to make sure that they can justify the corporate benefit when they see penalties of this size. In cases like UPS, I looked, it didn't seem that there was any equity offerings during the relevant time period, no equity used for M&A. So those might be challenges to establishing corporate benefit. And then, I'm curious the panel's view on whether or not we'll see these ICCs and additional undertakings for independent training.
You're teeing up all the right questions, right? Because we're talking a lot about what's relevant that's happened in the last, 6-12 months. And I think substantively, these are the kinds of things I would expect the staff to continue to look at, but what they look like on the other end and what the remedies look like could be very, very different given the change in administration. I think we're going to dig into that a little bit more after we talk a little bit more about a couple other developments, and I'll hit on them quickly. Carolyn, you want to give us like a minute on anything in the SPAC world? There were a few SPAC cases in the last year.
Yeah, there were a few SPAC cases. I think there was at least one IPO case. And we're in the spectrum in terms of, what stage was being looked at, materially misleading disclosures. Whether all of those cases would get through in the new administration, I think is open to question. Some of them had universal approval, some of them did not in the last administration. But I think the bigger takeaway is what you were just saying, Steph, and some of what Trevor was saying. And that's that this is a space that the new commission is going to continue to look at, is public companies and potential fraud. And at the start of an investigation, if the staff can articulate a potential fraud theory, then I think they're going to look at it because, I think you would say, you don't want to be the senior leaders at enforcement that slept on a major fraud. So the staff are gonna look into it. Now, whether at the end of the day, if there isn't a fraud theory that bears out, there's an actual case, or what that looks like or what the remedies are, I think that's where you'll see changes. But the investigations themselves, I think, will still be going forward.
Yeah, and I think just to put a finer point on it, I mean, when there's an announcement made of, for whatever reason, a material change, decline, for example, in the company's earnings, they missed the target by a large amount, there's a big write-down in some asset for some reason, we are going to look. Whether it's enforcement or the accountants in the Office of Chief Accountant or the accountants in Corporation Finance, we are going to look at it. Where it goes from there, obviously, just depends. But we are going to look and see, well, what prompted the change? What might the company have known about the change? And what did they say about it in the prior filing? So.
Yep. Jimmy, you want to talk to us a little bit about materiality and
Sure.
what we're seeing, what we've seen lately, and that's.
Well, so you asked me that question when we were prepping, and so I said,
Yeah.
I was like, let me see what's going on in materiality.
What is going on?
So what is materiality is the key threshold issue, right, to what we do. It's not material, it's not fraud, it's not lots of other things. So I looked to see, and I think what you find out is the materiality battle is primarily fought behind the scenes, putting aside plaintiffs' securities class action cases, where that's, it's fought in every single motion to dismiss. But at least on the enforcement side, that battle's usually going to happen between the company and its auditor and the dreaded SAB 99 analysis, which only comes back to haunt you when you're in front of Tom trying to justify why it's not material, or you're in front of Tom trying to justify because the investigations already beat you to the punch. And so I looked, the last significant statement from the SEC was in 2022 from former Chief Accountant Paul Munter, who's now retired. And that was primarily related to little r restatements versus big R restatements. And I think the practice and the trend that was out there where issuers were leaning heavily towards little r restatements. They're less disruptive, usually don't end up with a class action lawsuit on the back end of that, and it's usually not the result of fraud. But then you look at SAB 99. SAB 99 is approaching its 25th or 26th anniversary. So I think it was guidance in 1999. And maybe it's time, and I'm not sure this commission, no comment, Tom, of course, is the commission that's going to take that mantle up. But, things have changed, and the qualitative factors that everyone relies on and that, they struggle with when they're dealing with some sort of misstatement or whatever the underlying issue is, maybe it's time to dust that off. And it's time to update it to recognize asset classes that didn't exist 26 years ago. Metrics that are far more important now than they were in 1999. So I think hard to say where this commission will go with that, but I think it's a threshold issue. It's without materiality, lots of things don't happen.
Yep. I wouldn't be surprised if this commission took a hard look at it. It's the kind of thing where, as you suggest, it might be time for some changes and some sort of leaning in from the SEC on kind of giving guidance to the market. So I wouldn't be surprised if we saw something. Carolyn, last thing on sort of the backwards look. Tell us a little bit about what we're seeing in the 102E space, in the accounting professional space. I mean, the SEC is kind of, I'd say fairly quietly dismissed a bunch of administrative proceedings that were pending against individuals in the wake of the Jarkissi decision. And so what have we seen there?
Yeah, it's really interesting. The SEC has had some Supreme Court decisions, setbacks in the past around remedies, most recently Fokas and Liu. And there, what you saw was the SEC kind of retrenched, thought about its strategy, and then started, I think, picking very specific cases to, whether you view it as a clarification or an expansion or, what have you, to get decisions that were favorable to the SEC, that kind of further illuminated what those decisions stood for. And we haven't seen that with Jarkissi. Instead, as you said, we've seen the kind of quiet dismissal, including of a number of 102Es. And I think that's for a couple of reasons. First of all, Jarkissi isn't just strictly about remedies and penalties. It is also implicating, obviously, the administrative proceedings themselves. So it's more complex. I do think, though, that there's also the issue that it implicates not just the SEC. There are a number of agencies that don't have the ability to go to district court. And so wanting to make sure, I'm sure that, across the government, there was some thought of, which agency, not just the SEC, should be pushing this and, with what set of facts. But I do think that going forward, I don't know that it's a tenable situation. Auditing and accounting is such a big part of the SEC's mandate, and the 102E proceedings are, a very unique remedy to bar accountants from appearing and practicing before the commission. I wouldn't be surprised if at some point down the road, even the new commission decides this isn't something that we can continue to abdicate and instead looks for the right set of facts and circumstances. But in the meantime, we did see this past year, and Tom, maybe you can speak about this a little bit, filing a district court action to kind of try to replicate that remedy. So I don't know if you want to talk about that just a little bit.
Well, there have been at least 2 instances where in litigated actions, so complaints are pending and litigation will proceed, in the district courts where the SEC has sought as a remedy effectively, and I can read what we saw in the complaint, an order prohibiting the defendant from acting in an accounting or financial reporting role at a public company in connection with the preparation of financial statements filed with the commission. Okay. So the cases where we sought this relief was, we had charged a case in 2023 against a company called Tingo, and then basically a large-scale fraud case. And Tingo's accountant, I'm going to mispronounce his name, but it's Oyalinko Oyabola, was charged in September of 2024 for his role in the securities fraud. And as part of the relief, we sought that order from the district court, invoking the district court's equitable power to prevent him from preparing financial statements for publicly filed companies. And there was also a case against the furniture company Lovesac and 2 of its accounting professionals, the former CFO and the former controller, where in that case, the company settled. Their case against the 2 individuals is continuing, it's being litigated, and we sought a very similar relief against those 2 accountants for their roles in what we alleged happened at the Lovesac company, which was effectively, we allege, an accounting fraud regarding invoices and things. I won't get into the details, but the point is, we recognize that at least in some circumstances, it may not be appropriate for accounting professionals to continue working in public accounting. And these 2 cases show a potential avenue through litigations in the district court.
Although I do wonder, I think we'll still continue to see some settled 102Es, because I would think that there are probably going to be some individuals who don't want to litigate, or just like sometimes there are companies or individuals who would prefer an administrative proceeding settlement for various reasons. They're not going to want, even if it's settled, a district court injunction. Some people just view that differently. So I think settlements will continue.
And there have been settled 102E proceedings against accountants and lawyers over the past 6 to 12 months.
It's a fair point. When sort of making the transition on this panel into talking about, what's to come, I think you tee up the right question, Carolyn, right, which is, what will the SEC do? Because I think there will be a sense that in the building that you can't abdicate responsibility on this issue, but it's very tricky, and I won't get this exactly right. Joe Brenner would be horrified when I try to get this, but you can only do 102E proceedings, at least for improper professional conduct in an AP. The other thing that the SEC can only do in administrative proceedings are failure to supervise actions against, those associated with a broker-dealer. There's not another venue. There's not another place they can do this, and that's really the challenge. And I hear you on, they might look for the right facts to try to bring it, but I almost think if they have the right facts, they're going to try to do it in district court. It's such a high-risk proposition, I think, right? I would fully expect someone to litigate at a minimum the issue in an AP of whether a bar is a penalty. And that would be pretty bad for the SEC to lose on that issue for a whole bunch of, knock-on reasons. And so it's not obvious to me what the solution is.
No, and it's also a little more complex and difficult, like I said, because it's not just the SEC going to district court the way they did after Fokas and Lou in terms of, you're going straight to the district court. It's the SEC would be filing a contested AP, and then is that the one that then somebody takes it to district court and challenges, or which presumably they would, but it's not a given that the SEC picks the case and it's the one that ends up, going to court the way they want.
Yeah, so it's a pretty fraught area. And look, it's on other things you could maybe say, well, kick it to the PCAOB, but the same issue is going to exist for them,
yes.
And does, we've seen litigation around this issue with them, and so that's not an obvious answer for all the reasons you've already said. So sort of switching into the what's to come, what's going to change in this space. My expectation is certainly, again, we're here to talk about Ks and Qs. In the disclosure space, so less about, financial statement fraud and more about the disclosure, I suspect we're going to see changes in terms of theory, in terms of the cases we see charged. We're going to break them down a little bit by theory and talk about what we might expect to see. So I think, Trevor, why don't you kick us off? Talk about some of the sort of disclosure cases we've seen, like the pull forward cases and the MD&A cases and things like that. What do you think we'll see?
Yeah, I mean, the SEC does continue to bring disclosure-only cases, when there's disclosures about financial results or around financial results, but there's no underlying accounting error allegation. Often these cases involve some operational practices or change in operational practices that have a material impact on achieving reported results, but those changes or practices might not be sustainable. These cases, may involve incentives to pull forward and pull in revenues from future periods into the current period, delaying payments on sort of gaming your cash outflows and inflows to hit important cash flow metrics and the like. And the SEC charges these cases, leaning on item 303 of SK, because they affect the predictive value of the financial results that are being disclosed. Tom mentioned one recent example of a pull forward case is the Elanco Animal Products case, and again, when the music stopped on Elanco in Q1 of 2020, when they pulled back on their quarter-end incentives, the SEC faulted the company on sort of blaming that on COVID, as opposed to also attributing some of the decline in revenue due to that change in business practice. Other relatively recent disclosure-only cases, pull forwards, you have Under Armour, the VMware case, and Koppers Holdings, which was a cash flow matter as well. In terms of takeaways, I think the most egregious of these cases will continue to be pursued by enforcement staff. However, in touching on something Jimmy said, expect the materiality of these misstatements to be subject to some more scrutiny. How much weight are investors really putting in these either the effective GAAP measure or the effective non-GAAP measure? And so, we expect that, as part of defense in a pre-Wells or during the Wells process, to really want to engage economists to get a sense of how strong that corporate benefit and that materiality claim.
Is that like the kind of thing that like AlixPartners could do?
Maybe,
Jimmy, why don't you talk to us? We've seen a lot in recent years in what I'll loosely call the control space, right? Disclosure controls and procedures, ICFR, some a fair amount of standalone stuff, but also the charges layered in other cases. What changes do you think we're going to see there?
So I think I'd approach that a couple ways. So first, just to look at, because I always like to talk about cases where the SEC lost the motion to dismiss. So we'll talk a little bit about SolarWinds and just the internal controls piece, not the disclosure piece, far beyond. But I think there, and for those who aren't familiar with that piece of the case, it was a long opinion. The SEC charged internal controls violations, internal accounting control violations, as part of its disclosure violations case against SolarWinds, with the idea that SolarWinds, poor password protection, its poor IT protocols allowed unauthorized access to its source code and to its core products. And that under the internal controls provision, and I'll read it so I don't get it wrong, it's, one of them is management's access to assets, and that it's only permitted with general or specific authorization. So the idea being that the threat actor who got access because the password protocols were faulty or there was a gap in the software somehow undermined and got improper access to the assets of SolarWinds. And what the court did there was, looked into the history of the internal controls provisions and the books and records provisions, which all came into the securities laws as part of the FCPA. And so it was kind of went through the history that these are internal accounting controls and things like IT protocols, password protection. While it may govern assets, it governs IT assets, not your accounting assets, not your debits and credits, not your product, not your inventory. So really a pullback. In terms of what's to come, again, I'd like to think that accounting and financial reporting fraud is nonpartisan. I don't know of anybody who is for cooking the books, other than those who profit from it, and anyone who's really pushing for that. So I think it's still going to be the gateway. And look, we all as defense counsel sometimes have to argue for an internal controls or a books and records charge because we don't want that fraud charge. And so I don't think we're going to see a pushback on any of that. Again, the theories might be different. Maybe there'll be less aggression in some of those theories, but I think that combined with, again, also disclosure controls, you're probably not going to see much difference. And I think the other thing I just wanted to come back to briefly was in the Becton case. I mean, think about it. You said it's a $175 million penalty in a non-10b5 case.
Yeah.
So a negligence-based case.
I mean, it's no record keeping, but it's
right. Sure, right.
Well, I would suggest you read the order though in Becton. I mean,
right. The conduct's longstanding can get how you get to that number.
Right.
But I think that's also another thing you'd hope to see, and I know we don't see it, it's not commission practice, but there is a statute that governs civil penalties, right? And there is a statute that says, how they're supposed to be denominated. And again, this is not a Tom question, just my sort of editorializing here. Why not put something in those orders that helps the bar and issuers understand how we got to that number? And look, I think it's multiple years. It's a series of multiple missed opportunities to get it right that probably contributed to it, but pretty high, for a non-Siena-based negligence violation.
I suspect it's the highest for a 17A2 and 3 case.
So again, I think those are the questions we'll ask. You see that again off topic.
Yeah.
In the off-channel cases, large penalties would be nice to see. Was it just the highest number we could negotiate? We know it's more than that. We've all been in that room and we've all heard what comes back. There's precedent. There is some effort to try and figure that out. But I think that would be good to to understand at large. How do we get to these numbers?
Yeah.
And maybe we'll never find out.
Yeah, it's been a age-old ask, right, from the defense bar.
Not to pick on Tom, sorry.
It's not.
well,
like,
if you want it, we can do
yeah.
a separate panel on the off-channel cases.
God, no, my God.
Didn't mean to take it off topic.
Just following up on some of what Jimmy said on the controls stuff. Carolyn, anything from your perspective? And, are we going to see cases like Keurig and stuff like that, going forward?
Yeah, I mean, I do think we'll still continue to see in certain circumstances, certain fact patterns, the 13B2B, the 13A15 internal controls cases and the disclosure controls cases. I think, Jimmy's point is a good one that sometimes companies, clients do want that as a fallback, even to negligence-based fraud. And sometimes I think there are things that it's just not controversial to anybody that it hits controls. But I do think we'll see less of those cases. And I think in certain areas, we're not going to see the 13B2B charge, for example, when it comes to cybersecurity, except maybe in very specific fact pattern. But I think the 13A15 disclosure controls cases, that question of, what were the controls to make sure that the disclosures that are being made, are materially, accurate, not misleading, that the information is flowing up. I think that has seen less of the negative attention than 13b2b. So I wouldn't be surprised to continue to see that sort of internal control case in a cybersecurity case that rises to the level of disclosure fraud.
Tom, were you going to say
No,
something?
I was just
Go
going to
ahead.
say, there's also, I mean, not to start throwing statutes around, but there's 13b5, which is a different provision that basically you can charge an individual, it's not just an issuer, with circumventing, an implementer circumventing internal controls. And we do occasionally have cases where individuals go around the company's stated internal controls for some reason. And that's always, I think that's an option, especially because it tends to focus on the individual and the individual's conduct.
Yeah, I think that's right. Carolyn, why don't you take us into cybersecurity? I mean, it's been a lot this last year in terms of, in this space, in the disclosure space, both because, there's a new rule that's only been in effect for just over a year, and there's been, I don't know if confusion's the right word, there's been a lot of practice around how companies are choosing to comply with or address filings consistent with that rule. CorpFin has now come out and said some stuff to give some guidance, and we've seen a handful of cases that go to cyber disclosure, including 4 very recent cases that I think came off the back of SolarWinds, if I'm remembering correctly, but are interesting, I think, in the sense that these are companies that were victims and companies that made disclosures. But the SEC, my words, not anyone else's, is really second guessing the fulsome nature of those disclosures. And I think really took them to task, at least in the press release, for sort of not going far enough, for lack of a better way to put it. Carolyn, what can you tell us about these? And will we see more of that kind of case?
So I think we may still see some of that type of case in that people have been very focused, obviously, on SolarWinds and 4 cases, that came after that. There have been at least 1 or 2 others since then.
Yes.
And I think if you look back at the votes on those cases, again, I think there were issues around some of the control violations, but not around, on at least some of them, on the disclosure fraud, like the negligent disclosure theory. And so I think for that reason, and I think also just the fact that, we've talked about every company, is experiencing cybersecurity issues. And I do think there are a lot out there that are, really trying to get it right, and as you said, are grappling with, the SEC rules, but also, requests from different state regulators and, all sorts of different entities. I do think the SEC is still going to continue to view itself as having a place in this space. Again, kind of going back to something we talked about, at the beginning of the panel, I don't think that the new SEC leadership is going to want to be the one where there is a major cybersecurity event, with just kind of the perfect storm of facts. Went on a very long time, most sensitive data was taken, company knew about it, didn't disclose it, for years, and I think we've seen a few of those fact patterns even under, the first Trump administration that resulted in cases. Again, I think that the number of cases and how those are charged is probably going to look very different. But at the beginning, Tom was making this point, the staff doesn't necessarily know, is it fraud or is it not? And so I think that we will see those investigations, but what they look like at the end, I think that's where we may see differences.
That's my sense. That's my sense, is that it's going to be a policy issue. You got to look at it, right? I mean, there were, if you go back, 10 years, there have been tons and tons of very high-profile breaches. Many of them never resulted in cases. And I think there's a real prosecutorial judgment to be made there about whether, is the SEC expectation perfection? Is it a good faith attempt? Is it something in between? And I think there's been a sense, at least, across the defense bar, as someone who helps advise around this, that the standard's been perfection. May not be fair, but that's been a real sense, is that there's been a second guessing of good faith decisions. And I suspect we will see the pendulum swing on that a little bit. Whether it's a fair criticism or not, I think it will be evaluated a little bit differently on the back end.
And just one other thing I'd add to that. I think this is an SEC coming in that we are expecting is going to put even more focus on certain, traditional violations like insider trading.
Yeah.
It has always surprised me that there haven't been more insider trading cases around cybersecurity incidents. We saw one, years and years ago with Equifax, where the company was not charged by the SEC for anything related to the incident, but there were two individuals who took advantage and traded, ahead of the announcement that there had been a cybersecurity incident. That's the sort of thing where, I would expect to see also maybe some more resources and more attention paid going forward.
Let's, to wrap it up, why don't we talk about what we think remedies, in particular financial remedies, will look like in public company cases, right? Because we know that Republican commissioners view them differently in the sense that, it's laid out in the 2006 SEC penalty statement. Trevor, why don't, or Carolyn, who did I tee that up for? Either one of you, because you talked about it a little bit earlier today.
Go ahead.
Why don't Carolyn, you kick us off, and Trevor, you talk about the corporate benefit analysis. But Carolyn, how do we think the new commission will look at or think about public company penalties?
Yeah, I think that there's going to be a heightened focus. Tom probably would say the focus never went away, but I would say maybe it'll be heightened on that kind of key question that's talked about in the 2006 penalty statement of whether there was shareholder harm or whether there was shareholder benefit. That's not the simplest question to answer. There are economists at the SEC who spend a lot of time looking at that and oftentimes can quantify it and come up with a range. But a lot of different complex questions can go into who were the shareholders, during what time period, and therefore, was it a benefit or was it a harm? And so I think that there will be, a lot of attention on that going forward. I don't know if you or Trevor have things to add.
Yeah. I think we under the new administration, I suspect that fronting the corporate benefit, and getting DERA involved early and often on these cases is going to be a baseline requirement for requiring corporate benefits. And so I think, again, just being prepared to have those rebuttals, especially when there maybe hasn't been a corrective disclosure up into the SEC's, bringing its case. I think that those cases are there's a lot of play in the joints on what the corporate benefit could be.
Tom?
No, I would just say I think I would take issue with any assumption that we forget about the 2006, that the staff forgets about the 2006 penalty statement, on certain years, and we remember it in other years. The staff is well aware of the 2006 penalty statement. We're well aware of the factors, and the staff considers those factors in, I would say, all the relevant enforcement actions. Now, I concede that most of our orders, and this has been true, the orders don't set forth, well, this was a pro and this was a con when it comes to analyzing the factors. But I think when defense counsel engage in negotiations with the staff, those are topics that come up routinely. If you're representing a publicly traded company and the staff is insisting on recommending a penalty to resolve an enforcement action, you're going to be having those conversations. I think that's always been the case, and I think it'll continue.
That makes sense to me. I think what we will see change is the degree to which it matters to the majority of the commissioners. That is shifting. You can look at the votes and see the stuff that Commissioner Peirce voted no on, as to the penalty on, and I think that gives a good sense to how maybe the majority will vote, but maybe not. Not every, I'm not sure it's quite so black and white for every commissioner, but it's a fair point that it's a thing that staff's been considering all along, and I think Trevor's point is a good one for a takeaway as we think about how to interact with the staff on potential penalties in public company cases. We need to be doing our homework on these issues and being prepared to make rebuttal arguments because they may carry more weight than they have in the past. All right, well, thank you to my wonderful panel, and thank you to you all.